Welcome back. My name is Arya, and I don't waste your time. So let's get straight into it. Ladies and gentlemen, anytime there's a software company that is dominant in their industry, it tends to draw my attention. But then if there's a software company that is not only dominant in their industry, but they've been dominant for 40, 50 years, it's a screaming reason for me to start looking into that company. And in today's video, we're going to be looking at one of only a handful of companies to have been dominant in their respective industry for the past 50 years. And of course, I'm talking about Adobe Incorporated. Now, I'm sure many of you guys are very familiar with Adobe products and might have even used Adobe products in the past, but in today's video, not only are we going to be covering the general suite of products that Adobe has and everybody knows them for, but additionally, we're going to go over some of the other revenue segments that Adobe has. So without further ado, let's analyze Adobe stock from both a qualitative and a quantitative perspective to try to see whether or not this is a company that could outperform on a going forward basis. For starters, I want to start us off not even with anything Adobe related, but this is a quote that I was able to find from the Intuit podcast on business breakdowns. I'm going to link it in the description if you want to check out the entire podcast. But long story short, there's a quote in here that has just stuck with me, and I think about this literally all the time. They say here, and this is actually from the Moody's CEO, Ray McDaniels, which if you didn't know, Moody's is the credit rating agency company, and he describes his business as a standards business. What he means by that is he says it's a business where the network effects created by your past sales gives you the right to make your next sales. And essentially what he's saying by that is because in the case of Moody's, they're the standard of their respective industry, people that are going to be getting a credit rating in the future, they're going to want to get a Moody's credit rating because Moody's is recognized as the standard of that industry. You could extrapolate this and apply it to even something like Microsoft. Because Microsoft Excel, PowerPoint, Word, and just the entire Microsoft suite is recognized as a standard of, if you want to, go on spreadsheets and whatever, like everybody has that mind share of spreadsheet means Excel. Because they have that mind share, their previous sales that they've made in the past 50 years allows them to make their next sale. You could extrapolate this and apply it to FICO. You could apply this to Intuit, which is mentioned in this podcast right here, right? There's a lot of these businesses where because they have this mind share of the past 30, 40, 50 years of being the standard of that industry, they're going to continue to be the standard of that industry until something drastic happens, which in most cases, nothing drastic ever happened. And this also applies to Adobe. Establish my point, I'm going to jump over to Morningstar, which is a research firm that I like to include in my videos, and I'm just going to read you an excerpt from the report that they put out on Adobe. They say, we believe Creative Cloud, which is of course the Adobe suite of products, enjoys the widest moat under the Adobe umbrella. Like most software solutions, once Creative Cloud or any of the other individual applications contained therein is inserted into the workflow of creative professionals, it becomes very difficult to change solutions. And then a little bit further down here, they mention, because nearly all creative professionals rely on Creative Cloud, all other creative professionals must also use it. This is the network effect, classic network effect. This is why Adobe has a very wide moat. Because it's been the standard for the past 40, 50 years, and all the professionals, all the digital designers, all the web people, all the UI, UX people, like literally everyone has been using Adobe for the past 40, 50 years and have learned how to use Adobe. That creates insurmountable network effects in the industry. And sure, maybe Figma and Canva and some of these other competitors, sure, they might be better in some cases. In Figma specifically, I think they literally run advertisements saying, if you want to do UI, use us. If you want to do UX, go use Adobe, right? Or like some version of that. To combat that, I have another quote from Morningstar here. While the Creative Cloud has its issues, particularly premium pricing, and any one organization or freelance professional might be willing to switch, they would find it difficult to work in an industry that has generally standardized around it. Similarly, Adobe's large installed base helps ensure that when the company releases or acquires a related solution, it immediately faces a substantial and welcoming audience. This is the Microsoft playbook all over again. This is exactly what Microsoft did. So again, this is like the 10th time I'm repeating myself, but even Morningstar literally says it right here. It's standardized in the industry to use Adobe products. And because it's standardized, it's going to enjoy massive network effects. And then on top of that, because Adobe is the biggest scale player and the biggest competitor in their industry, every time they acquire a new company, let's just say they didn't have Photoshop, and then all of a sudden they decide to acquire Photoshop and the photo editing suite, right away they could add Photoshop to the current bundle they have for like an additional $2, right? So if you have competitors that is just the photo editing app and they're charging $10, why would I use Figma if I could just jump over, buy the entire suite of products from Adobe, gain access to all of it for like $10 more? Right? Isn't that a much better value proposition? And this is exactly what Microsoft has done for literal decades. They just keep buying up new software companies, keep bundling it into their little package of softwares that they sell. And after 2 decades of doing that, there is no competitors. Now, with that in mind, Adobe, I would say it's probably a little bit younger than Microsoft in the S curve of growth that they've experienced in their respective industry. Nonetheless, there is competitors to Adobe. And Figma, of course, being a notable competitor that Adobe actually tried buying, I think roughly a year and a half ago. This has been somewhat of a disaster for the business. If I were to rank the various risk factors of the business, I would probably rank this number 1. And the reason for that is I've actually spoken to some graphic designers. And previously, I thought there was like a lot of switching costs incorporated with trying to switch off of Adobe. If you're used to the user interface of Adobe, and if you've been using Adobe for so long, odds are you're not just going to randomly switch away to Figma or some of these other competitors, right? Just like that. Like, it's not that easy. You're so used to it. Same thing with like Excel and all that type of stuff. But I was wrong. And my friend, he actually switched away from Adobe and he no longer uses any Adobe products, and he simply just uses Figma to do his graphic design work. And of course, Adobe saw this as a risk factor for the business. They saw this fast-growing, tiny little company that's coming up, and they're taking market share away from their core Photoshop offering. And so, in true Microsoft and Adobe monopolizing fashion, what Adobe decided to do is they said, hey, why don't we just overpay massively to just get rid of this, like even the headache of possibly having to compete with these and allowing them to get too big, right? And so they offered $20 billion for a company which at the time was doing roughly $400 million in revenue. And to give you an idea, that's 50 times price to sales. So if Figma were to not grow and just churn out that revenue, in 50 years, they'll be able to return in revenue, not profit, guys, what Adobe paid for that business. Obviously, just a massive, massive overpaying for that business. Now, of course, this is just complete like antitrust monopolizing practices. Roughly 15 months into the acquisition and back and forth between Adobe and Figma, what had ended up happening is the deal fell through. And once the deal fell through, there's something called a breakup fee. So if for whatever reason, the bigger company buying the smaller company, for whatever reason, if the deal doesn't go through, the bigger company has to pay a breakup fee to the smaller company. How much was the breakup fee? It was $1 billion. So I'm going to remind you again. Figma did $400 million in revenue, and Adobe, in the process of not being able to acquire Figma, paid them 2.5 years worth of their revenue. Now, I'm going to jump over here to FinChat to just give you an idea. Adobe has operating margins of 35%, and it's a very mature business. So I don't think Figma has operating margins of 35%, but let's give them the benefit of the doubt. If Figma also has 35% operating margins, that means that at the time that Adobe was trying to buy Figma, Figma was doing roughly $140 million in operating profit. So when Adobe paid them $1 billion, right? They just paid it to them for not being able to acquire them. That's roughly 7 times their operating profit. So what's the moral of the story? Adobe essentially failed to acquire a competitor, and in the process, funded that competitor's operations for years and years to come. This is actually a similar situation to what happened with AT&T, I think roughly in the 2018 timeframe. They tried buying up a smaller competitor, and in the process, they actually ended up funding their business for a number of years, right? So again, this is a risk factor to consider, that Figma is winning the hearts of graphic designers all over the world, and it's an incredibly fast-growing company. I think they're actually supposed to IPO in like 2025 or something like that. So again, something to consider. There is competition, and the competition is growing, and that's something to watch. But nonetheless, I think it's like the age-old Microsoft playbook, right? Like they just keep packaging on these softwares into, and it's ultimately the best bundle that you could purchase as a professional working in the industry. So I don't know, very tough task cut out for Figma, but nonetheless, they're executing on all fronts as it stands currently. Definitely something to watch on a going forward basis. Now that we covered over the moat of the business, the competitive advantages, and why I think it's an absolutely phenomenal business, of course, that's all great. But if the company doesn't have the fundamentals to back all that, but I wouldn't be making a video on Adobe if it didn't have the fundamentals to back it. Now, on a rear view, like trailing basis, the growth metrics look absolutely explosive. If you look just simply off of the revenue metrics, you see that it's been in the low to high teens in the past decade. I don't really expect this to continue. I think roughly like an 11, 12% CAGR on a going forward basis is probably more reasonable. And it seems that the analysts tend to agree with me here. So the analysts on a 2-year basis, they expect roughly 11% revenue growth. I'm saying just a little bit higher than that, maybe like 12% range. And then the EPS long term, this is analyst expectations for the next 3 to 5 years. They expect roughly 17%. And honestly, I think that is reasonable if we're taking into consideration roughly like a 2% buyback. And then on top of that, add on a little bit of margin expansion. I think a 17% growth rate for the next 5 years is probably reasonable. And then jumping over to the balance sheet of the business, you would see that it's an incredibly cash-rich company. They have just under $3 billion more cash than they have debt. And of course, the margins. I mean, the margins could not be more beautiful. So gross margins of roughly 90%. That means that it costs them about $10 to generate $100 of revenue. To give you an idea, gross margins of the S&P 500 is roughly in the 35% range. And the same could be said about the operating margins. Operating margins are just absolutely beautiful. Another interesting thing that I noticed is the operating and the free cash flow margins are roughly the same. Usually for a lot of other companies like Salesforce and stuff, the free cash flow and operating margins, there's usually like a pretty big discrepancy between the two. So I don't know, just something interesting I noticed. And then additionally, one last thing before we jump over to the valuation of the business, I just wanted to mention that on a trailing basis, if you're looking at how much stock-based compensation the company issued compared to their free cash flow, it looks a little bit lumpy. This is just simply because we've seen a slowdown the past like 2 years on software spend. So as a percentage, historically, stock-based compensation has been like around the 20% mark, maybe a little bit under. And if you just look at the last 12 months, it's been roughly in like the 26-7% range. And then I did say one last thing, but this is the actual one last thing. I wanted to mention the digital experience side of the business. This is roughly like 25% of revenues. And this is like a bunch of random stuff in there. So any company they've acquired over the years, they kind of just chuck it into there. But like namely, they have a pretty big analytics arm, which based off of what I've heard, they're like 2 years ahead of competition. So apparently they're just destroying it in their specific niche of analytics. And then on top of that, they have like customer relationship management stuff in there and that type of stuff. Maybe in when I do a follow-up video on this for like earnings and stuff, which is I think in a couple days actually, but when I do a follow-up video on Adobe, maybe we'll dive a little bit more deeper into that. But yeah, apparently like it's a pretty fast growing segment, and apparently they have very high switching costs on that side of things. Now last, jumping over to my valuation spreadsheet, which I include in every single one of my videos. Long story short, we take the current valuation of the business and we're dividing it by how fast we expect the company to grow at. And of course, we do it with free cash flows, not earnings, because free cash flow is what can be distributed to you and I, the shareholder of these businesses. And long story short, I'm taking $8 billion of forward free cash flow, and I expect those free cash flows to grow at 15% roughly. So if we simply just take the formula here and we drag it down, you'll be able to see that Adobe is roughly around fair value according to my model. Now, what's interesting about this is you can start to play with the numbers here to try to see what is needed to happen in order for Adobe to be undervalued. So first and foremost, if you just simply bump the growth rate to 17%, which the analysts expect roughly 17% earnings per share growth, but we're talking about free cash flow here. And as you just saw a second ago, operating margins and free cash flow margins are roughly 1-to-1. So I'm like, this is probably reasonable. If you assume that Adobe is going to grow at roughly 17% for the coming years, it seems to be undervalued as it stands currently. Now, tack on the fact that maybe, Adobe slides and the stock price goes to like roughly the $420 range or something like that, then you could see that Adobe is like comfortably undervalued. But as it stands currently with a little bit more conservative of estimates, I think Adobe is probably around fair value, and of course not financial advice. And I think this is a company that I honestly might end up buying in the future. If the valuation goes down a little bit more, of course, as it stands currently, I do have the opportunity cost of just buying a lot more Salesforce, and I'm not afraid of doing that. So in my personal portfolio, which is pinned at the top of my page on Twitter, you could see that I have a very large holding in Salesforce. Jumping over back to my spreadsheet, you can see that according to my spreadsheet, Salesforce is very undervalued as it stands currently. So I do have the opportunity cost of continuously buying more and more Salesforce. And I'm not one to be worried about concentration risk. And even in this tweet over here, I'll honestly even go up to like a 50% allocation in Salesforce. I really don't care about the concentration risk. I don't really believe in diversification either. If Salesforce continues to trade at such cheap valuations, I'm going to continue to buy it. So Adobe, it would have to slide a little bit more in valuation. And on top of that, the mere fact that it does have like a pretty good amount of competition, I need to do a little bit more research before I'm comfortable buying on that front. But I don't blame any of you guys if you're accumulating at these prices. And at last, if you like the fact that I don't waste your time, I'm going to ask you to do something that costs you nothing. If you can hit the subscribe button, I'm going to continue to post high quality videos just like this one. And you can always go back on that decision if you end up not liking the videos, but I highly doubt that. Thank you for watching and have a great day.